Doctor, we have Professor Patrick Mardini. He's the Assistant Professor of Finance at the University of Belmont in Lebanon, and he heads his own think tank as well, and we're really happy to have him here. So let's welcome him.
Thank you. Is it working? Yeah. So when first Brian asked me to talk about this topic, I said, "Oh my God, everybody before me takes the good topics, the exciting stuff about Bitcoin, blockchain, and I get to talk about monetary policy and business cycle. I mean, that's all the stuff." But then when I started thinking about it, monetary policy is an important issue, right? It creates sometimes economic growth. We call it boom. It can sometimes create bust, which is crisis. Sometimes it is used to justify bailout. So when taxpayers' money is given to banks in order to save the economy. And those are all interesting topics. And Brian wants me to talk about that, about how monetary policy can produce economic crisis and try to connect it to Bitcoin in a way, which would be a stretch that I will try to do. But before starting with my topic, I am very happy to be here in Singapore today, and the reason I'm very happy is that you guys. Oops, what did I do? No. Oh. So this one. Which one? Okay. And is it working?
I think it's hanging.
That's a conspiracy. I can do it without. Well, they were coming actually. They knew I was going to talk about monetary policy, and they screwed everything. But I get the longest time on the stage, at least. That's the. So do you know where Lebanon is located? Just the time is. Who have heard about Lebanon before? Wow, too many smart people. It's the first time I have that many people who've heard about my country. Okay, good. So are we back? Can I hit the button without? Great. And that's why I love Singapore. I love Singapore because you guys have the best dim sums ever, right? It's really good, it's really delicious, and if you want to eat dim sums, you need to come here to Singapore, right? And I really love it. As you can see, that's me in the picture, eating a lot of those dim sums, and they are really delicious, right? I really like dim sums to a point where I thought about opening my own dim sum shop, right? Because when you open your own restaurant, well, you can eat as much dim sum as you want, and nobody will charge you or check you, and that's a great news, right? That's fabulous. I mean, look at me. That's what I like to do, okay? So basically, now the real problem is I need to find the correct price of the dim sum, right? At which price should I sell this delicious food? So how much is the price of a piece of dim sum today in Singapore? Like, the piece. Is it like $1 or something like that? Yeah, about $1. Great. So I need to open my restaurant, I need to sell you dim sum. If I sell it at a very high price, like $10 per piece, well, it would be very hard to find buyers. And, I won't be able to sell you those food. And if I sell it too low, like at, 10 cents for the dim sum, I will make losses and I will end up bankrupted, right? So actually, I need to find a certain price that would cover my costs, maybe allow me to do some profit, but that is not too expensive or else I will lose my clients, right? Which is the basic things. And this price is mostly the market price. So I need to see what other people are charging and then try to align to them with a certain margin, right? That's how usually prices are set in the economy. Now imagine that I have the government coming and regulating my dim sum prices, right? And the government said, okay, you need to sell your dim sum at, let's say, 20 cents the piece, right? Well, at 20 cents the piece, what do you think will happen? Well, I will have many clients coming to my restaurant, waiting in line, asking for dim sum, but I will not supply anything. I won't be able to sell anything, because if I do that, I will lose a lot of money and I will go bankrupt, and I don't want that. So actually what will happen, we will have shortage, right? We will have shortage. When the price is too low, is set to be very low, we will have a shortage. Now on the contrary, if the government sets the price very high and said, you know what, you are obliged to sell your dim sum at $10 the piece. Well, I would love to do that, right? I mean, that would be jackpot for me. What would be the consequence? What would be the consequence? No buyers. My restaurant will be empty, right? And I will make a lot of losses as well, right? So as you can see, playing with the market prices has severe consequences on both the consumer and the producer, right? Playing with the market prices would affect, well, basically would either lead to shortages or it will lead to no clients, right? So, and that's a big problem. Well, the same thing applies to monetary policy. So the same thing applies to interest rate. Interest rate is a price. It is what we call the price of time. It is the price that determines or that comes from the individual preferences on whether they would consume today or save the money and consume tomorrow, right? That's the choice they are trying to make. Same thing for companies. So interest rate is a kind of price that brings the market of investment and saving into a kind of equilibrium, right? So you have people who want to save. If interest rate is high, it means that many people it means that you need to encourage people to save by giving them high interest rate. And investors also, when they need to borrow money, well, they need to pay the interest rate. So the interest rate is a kind of the equilibrium thing, like the prices of dim sum, right? If it is too high, you won't have enough client. If it is too low, well, basically you won't have enough sellers. And same thing for interest rate. If the interest rate is too high, many people would love to save money, but nobody will borrow the money and invest it in the economy, right? And if the interest rate is too low, well, nobody would save money, right? And so basically, there is no available. Many people would love to borrow and invest, but there are no savings. So that's the main idea here. So now imagine that the central banks come in and sets interest rate very low, right? So if interest rates are very low, would you put your money in the bank? I mean, you know, if interest rates were high, they are offering you 5% on your deposits, you would say, oh, that's a good deal. I would love to put some of my money at the bank, right? But if interest rate is too low, you know, you discourage savings, right? However, if interest rate is too high, well, basically you are encouraging investment. So normally, the logical consequence is that because interest rate is very low, many people would want to borrow money, but there is no money available to lend them, right? Because nobody is depositing their money at the bank. And so normally, you should have shortage of money, right? When we have low interest rate, we should have few saving, and since we don't have savings, we cannot lend people money. Does it make sense? Right? It makes sense? Is it complicated? No, it's good? Great. Well, in reality, that's not what happens. What happens is something different, which is instead of having shortage of fund, the central bank does not only set interest rate too low, they also print a lot of money. Actually, they don't set interest rate low through a decree or a decision. They push it down through printing more money. So actually what happens here is that we don't have enough savings. I'm searching for the pointer, I can't find it. Anyway, we don't have enough saving. People did not save money. Many people want to borrow money, and guess what? They find the money. Where do they find it? Well, it's at the printing machine, right? The central bank just print it and hand it to them, right? So actually, this monetary system is able to finance investments, although no savings have been made, right? And this is truly magical. This is really cool for some. You know why? I mean, if you can finance investments, it means that people can borrow money, they can open businesses, they can hire people, they can grow the economy, and that's really cool, right? So now we have a device which is low interest rate and printing money that will help us grow the economy without even saving money, right? So we are investing money that we didn't even save, and that's really cool because it allows us to grow the economy, right? At least many people think that way. Unfortunately, this idea is very, very wrong, right? So, in many cases, and I can think about the last subprime mortgages crisis in the USA in 2018, many developers borrowed money to build apartments, right? To build buildings. And what happened is that they got the money, the paper money, the printed money, they built those apartments, but at the end of the day, nobody was able to buy them. And you know why nobody was able to buy them? Because people did not save the money. You don't have saving. How would you buy them? Right? You don't have saving. You know, money was used to produce more cars, to expand the factories. But guess what? People did not have money to buy those cars because they did not save at the first place. Those investments were funded by printing more money. And they did not correspond to actual saving. And this lack of saving means that after the investment process is over, well, you won't find any buyers. And this is the bust of the cycle. So when the central bank prints more money, reduces interest rate, you will have economic growth. That's probably what is happening today in the USA, right? Interest rates are too low for a long time now, and I think that we are having a boom, but it's quite artificial. It is fueled not by saving, but by this paper money. And the consequence of this boom is actually this. We will have a lot of investments in sectors that people don't want to buy because they cannot simply afford it. Okay? Good. Now, some people would say, but you know what? We need to do it. The central bank needs to do that because when we do that, we are actually creating jobs, right? And if we don't spend money, well, if we don't print this money and give it to the investors, nobody will work in the construction sector, and the people working in the construction sector will be unemployed and poor, right? And, well, actually, there are two answers to this point. The first one is that those jobs are actually artificial jobs. I mean, you are investing time and resources to build an apartment that nobody would buy, right? So that's actually a waste of resources on one hand. But on the other hand, and more importantly, we always need to remember from where this printed money came from. And in reality, this money came from your own pocket. When the central bank prints more money, the central bank is diluting the value of the currency. So if you had saved in 1970, let's say $100,000, in 1970 this $100,000 would have bought you a lot, right? Well, in 2010, the same $100,000 would only buy you 18% of what it used to buy you in 1970. So what happened? Why did your money lost value? Because simply the central bank printed money. When the central bank prints more money, the central bank is shifting value from the holders of the currency, people with savings, people with salaries, right? We are shifting the value from those people to the people who would borrow the money eventually, which are those companies that are invested in buildings or in cars that nobody would like to buy. So actually what the central bank is doing, the central bank is shifting purchasing power from some people to other people. It is shifting purchasing power from people who were able to actually buy some goods with their money, right? Maybe buy my dumplings or my dim sums, right? and maybe I would have expanded my dumpling business if the money was not printed and the money was not diluted. So actually, what they are doing, they are hurting my dumpling business. They are taking the jobs out of my dumpling business, a business that would have offered to the consumers something they want, and they are shifting it to the construction or to other activities that do not fit the consumer needs. And that's what the central bank does. The central bank never creates jobs. The central bank simply shifts jobs from one sector to another sector. So, I would love you always to remember that whenever we have a loose monetary policy, whenever you listen to a politician saying, I want to keep interest rates low because I want to create jobs, right? Or a central bank saying, you know what, our mandate is to create jobs or to create more growth. Well, you need to remember three things. One, they are taking your own money through inflation, right? Remember that. So this money does not come out of the sky, it comes out of your pocket. Two, they are shifting this money to inefficient businesses that will end up failing. That's what we call the business cycle. And three, they are taking this money out of productive businesses, right? So each time they come and they promise you jobs, through this expensive, expansionary monetary policy, well, you need to think twice before rushing into it. So that's my simplified story on the business cycle. And now I am supposed to link it to Bitcoin and cryptocurrency. So good luck with that. That's a very difficult stretch, but I'm going to try to do that, okay? So the big question becomes how we will put discipline over the central bank and over the politicians. How we will say to the central bank and to the politicians that manipulate the central bank, stop printing money, that's bad. You are making things worse, not better, right? How would you discipline a central bank? And we tried many techniques. We tried to have a rule, like the central bank has one objective, which is to maintain price stability. But clearly with my dollar chart, you've seen that central bank did not maintain price stability. They failed to do that. Well, we can have another rule, which is like the central bank should grow money supply by 2% per year. Clearly, it does not work. Whenever you have crisis, they will print a lot of money in order either to bail out the bank or to bail out the economy or, to create jobs. So the temptation is always here. And those rule-driven things don't really work, right? And this thing was clearly identified by Friedrich Hayek, the Nobel Prize of Economics, back in the days, in 74 or 76, I think, in his book, The Denationalization of Money. And the idea here is to say that monopolies are bad, right? Imagine that I have the monopoly of dim sum in all Singapore, right? So if you want to eat dim sum, you don't have the choice. You need to come to my shop. What will happen then? Well, I can charge you $50 for my dim sum, and you don't have the choice. If you want to eat the thing, you need to come to my shop, right? As you can see, monopoly drives prices up. Monopoly also makes the quality bad. If I sell you a very bad quality dim sum, and I have the monopoly, well, you don't have the choice. You need to buy it from me, right? So we know in economics that monopoly is very bad. Why then would we stick to a monopoly in central banking? Why don't we have a competitive system that produces private money, private currencies? And this system was imagined by Friedrich Hayek, who said that, you know what, we can imagine banks or private organization, each one issuing their own money, right? And you might say, oh, but that's a crazy idea, because if I have a bank and I start printing my money, I would print an infinite amount of money in order to become, and take it myself, in order to become very rich, right? So what would prevent me from doing that? Well, if I do that, my clients won't use my money, they won't come to this bank, and they will go to another bank. So the only guarantee for clients to use my money is actually to have this discipline. So this competition between different issuers of currency might lead to a more discipline than the central bank being subject to political influence, printing the money as a monopoly, right? So that was the idea, the theoretical idea of Hayek. And guess what? Well, you see the atlas, that's a representation of Tom Palmer's institute. And so the man you see on the left is Larry White. The man you see on the right is George Selgin. And those two economists, especially Larry White, they discovered that central bank is a recent invention in the history of mankind. It dates like 100 years ago or 150 years ago. And before that, we used to have what we call the private banking, which is private issuers of money. We used to have bank. Each bank used to issue its own money, try to convince the clients that, you know what, my money is better than the other's bank money because my money does not lose value. I don't have inflation on my money. And this competition of keeping the value of money was actually ensuring a price stability. And this huge period, this period of huge inflation, we only seen it after the creation of central bank. So this system of different private producers producing money has already existed in history. And that's why some people would think that cryptocurrencies is actually a reincarnation of this old system that worked in the past, where we have different issuers of currencies. Each one would compete to tell you that, well, my currency, Bitcoin, is better than your currency, Ethereum, or whatever, right? And this kind of competition will make sure that we won't have inflation. Because, for instance, the amount of Bitcoin that can be issued is controlled by a logarithm, which is a better guarantee than a central bank influenced by the government. So we have those theories stipulating that actually cryptocurrencies can be a solution for inflation and can be a solution for the booms and the bust, the financial crisis and the economic recessions that we have in the economy. Well, I don't want to disappoint you, but I don't think that Bitcoin is capable of doing that, at least not yet, okay? And I will conclude on this note. In reality, Bitcoin is not a currency yet. Cryptocurrencies are not money. Cryptocurrencies do two functions. They are a money transfer device. So if I want to get my money out of China into Singapore, I can use cryptocurrencies to do that. So it's like using a bank transfer, but it's not really money. Or they are an investment tool, right? I put my money in Bitcoin because I know that the price of Bitcoin will go up, and that's really cool, and I will become rich, right? So actually, it's more an asset in which I invest, right? Cryptocurrencies can only become currencies if they become, of course, a generalized means of payment, which means that everybody will accept them. But I would go one step further. They will only become money if we start having deposits and lending in cryptocurrencies. Today, if you want to put your money at an exchanger, the exchanger will charge you a fee. You are paying money for safeguarding or for their services. Once the exchanger starts paying you interest over your Bitcoin deposits, because he knows that he can lend Bitcoins at a higher interest, only then cryptocurrencies will become money, okay? The problem here is that who will guarantee the contract? If I lend you Bitcoins, what is the guarantee for me that you will pay me back? Who will enforce the contract? Will it be the government? Does it mean that Bitcoin can only become a currency if the government guarantees Bitcoin? If it is the case, then Bitcoin is not really a revolution against the government, and it will not lead to anarchy. Thank you.